Welcome back to the deep dive. We've got the latest on ICICI Prudential Life Insurance, and you're looking for the key takeaways? Fast.
That's the plan.
So let's dive right in. We're really zeroing in today on their performance in that final quarter, Q4 of the fiscal year, ending March 31st, 2025.
Right. And how that quarter kind of fits into the whole year's story.
Exactly. We've got the board meeting notes, the financials standalone and consolidated, plus the earnings call transcript and their investor deck.
A good set of materials.
Our mission: to pull out the crucial highlights, the challenges, the outlook from that Q4 period without drowning in data.
Sounds good. Focusing on Q4 gives us that sharp perspective on their recent trajectory. Let's see what the numbers tell us.
Okay, let's kick off with the overall performance. For the full year, FY25, total premium growth looked pretty healthy, 13.2%.
Decent growth for the year.
But drilling down into Q4, that final quarter, how did they fare? Well, they still showed solid momentum, 11.1% growth in total premiums.
Okay, so they kept up a good pace right to the year end. That's positive.
Now, expenses. For the full year, they were up 12.6%. But here's where Q4 gets interesting. Expenses actually dropped in Q4 by 2.1%.
Oh, really? Down 2.1% in just that quarter. That definitely stands out.
It does. It suggests, maybe some serious cost management focus in those last 3 months.
Yeah, you'd have to wonder what drove that and if it's, sustainable going forward. It's a key Q4 takeaway.
And then there's the profit after tax figure for the full year. It's reported as, get this, WEDE 11.89 trillion.
Trillion. Wait, that can't be right, surely. For Beatty.
I know, right? It seems, astronomical. Almost certainly a reporting issue. Maybe billions were intended, not trillions.
Yeah, that sounds much more plausible. We should probably flag that as likely an error in the source material.
Definitely. But even setting the scale aside, understanding the profit trend, whatever the real number, and Q4's contribution is important. Their assets under management, AUM, hit 3.1 trillion by March end.
Okay, 3.1 trillion AUM. That shows consistent growth through the year. And Q4 would have played its part, especially with that premium growth we saw.
And their solvency. How did that look at year end?
Very strong. Ended the year at 212.2%.
Wow.
Yeah, and that's up quite significantly from 191.8% the year before.
That's a big jump. What was behind that, especially considering the Q4 position?
Well, during FY25, they raised $14 billion through subordinated debt. That certainly helped bolster it.
Okay.
And remember, they also had that earlier Euro 12 billion sub-debt with a call option coming up in November 2025. Keeping that solvency ratio high, especially through Q4, might be strategic. Thinking ahead about potential regulatory changes like RBC implementation.
Right, makes sense. Let's shift gears to embedded value, EV, that core long-term profitability measure. Where did that land?
As of March 31st, 2025, EV was $479.51 billion.
Okay.
That's a solid 13.3% growth year on year, up from about $423 billion.
And the operating profit from that, EVOP?
EVOP for the full year FY25 came in at $55.34 billion.
Which gives a return on EV, ROEV.
13.1%. So decent returns there.
And that 13.3% EV growth, presumably Q4 contributed positively to keep that trajectory going.
You'd assume so, yes. It points to steady value creation through the year. But when we look at the value of new business, the VNB, there's a slightly different story.
Okay. What's happening with VNB?
Well, VNB itself grew in FY25. It reached $23.70 billion, up from $22.27 billion. So they wrote more profitable new business overall.
That sounds good.
It is, but the margin on that new business, the VNB margin, actually dipped. It went from 24.6% in FY24 down to 22.8% in FY25.
Okay. So volume up, but margin per sale down a bit. Why the squeeze? Did Q4 play a particular role here?
The earnings call pointed to a couple of factors, and yeah, these likely had an impact throughout the year, possibly intensifying or becoming clearer in the later quarters like Q4.
What were they?
First, operating assumption changes, specifically how they account for expenses, which got tweaked because of the product mix shifting more towards unit-linked or ULIPs.
The ULIP effect.
Exactly. More ULIP pays can mean higher upfront acquisition costs, which can pressure that immediate margin calculation, even if the overall business grows. Second factor was economic assumptions, mainly changes in the yield curve.
Right. And were there any other sort of specific adjustments affecting the numbers, maybe becoming apparent late in the year?
Yes, there was a specific negative hit to EV of about $2.54 billion. This came from strengthening their operating assumptions again, but this time specifically in the group credit life business.
Why the change there?
They noticed delays in claim reporting. Claims were taking longer to surface than they'd initially planned for, so they had to be more conservative, put more aside. Sounds like something they probably identified and acted on in the second half, impacting the year-end and likely Q4 numbers.
Makes sense to be prudent there. Did they talk about sensitivity to interest rates? That's always a big one for insurers.
They did. They ran the numbers. A 100 basis point hike in rates could knock about $3.5 billion off EV and $3.7 billion off VNB.
Oof, quite sensitive, especially VNB.
Yeah, management acknowledged the VNB margin sensitivity, but said they feel they can reprice products over time to manage that. Something they'd definitely be watching closely through Q4 and heading into the new year.
Okay, let's talk product mix. What was selling well in FY25, and were there any shifts noticeable, perhaps, in Q4?
So for the full year, looking at APE, that's annualized premium equivalent linked products, ULIPs, were the biggest chunk at 48.3%,
Nearly half the business.
pretty much. Then non-linked savings at 21.2%, protection was 15.7%, annuity 8.4%, and group funds made up the rest at 6.4%.
How did the different categories grow?
Savings overall, including annuity, grew a healthy 16.6% year-on-year, and retail protection, that showed really strong growth, up 25.1% for the year.
Impressive growth in protection.
Definitely. And what's particularly interesting for our Q4 focus, they specifically mentioned a revival in their non-linked business during that final quarter.
Ah, so a bit of a comeback for non-linked towards the year end.
Seems like it. Suggests maybe a shift in momentum or customer preference as the year closed out.
And distribution channels, how are they reaching customers, and any changes there, especially later in the year?
The full year mix was agency leading slightly with bank assurance, close behind agency at 28.9%, banca at 29.4%, direct channel was 14.4%, partnership distribution 10.9%, and group 16.4%.
Okay, fairly balanced. Any particular channel dynamics worth noting from the Q4 perspective?
They did mention the partnership distribution channel saw more muted growth overall in FY25.
Any reason why?
Partly because that channel didn't participate as much in the big ULP surge earlier in the year, and also adjustments they had to make after those surrender guideline changes came in.
Right.
But importantly, they stressed they've increased their focus on protection within that partnership channel and saw growth there. That push likely gained steam in the second half, including Q4.
So they're adapting there.
Yeah, and they think that channel might actually see a rebound if markets get choppy and people start looking more towards guaranteed products again.
Interesting. Okay, moving beyond the core financials, what about other key performance stuff? Operational highlights, strategic moves, anything pop out in Q4 or for the year?
Absolutely. They really hammered home their claim settlement ratio, 99.3% for FY25, which they state is industry leading. And a super quick turnaround time for straightforward death claims, 1.2 days on average.
That's crucial for customer trust, a focus they likely maintained right through Q4.
You'd think so. They also pointed to their long-term track record. 5-year compound annual growth over 15% for both EV and AUM. Consistent performance.
Solid long-term view. Any new initiatives?
Yes, the introduction of ICICI Prudential. It's a suite of digital tools and analytics.
Ah, the tech play.
Exactly. Aimed at understanding customers better and making their distributors more effective. And this kind of digital push probably ramped up through the year, maybe showing more impact in the later quarters like Q4.
What about persistency? Customers sticking around?
Their 13th month persistency looks good at 89.1% overall, though they did flag a bit of a dip on longer-term persistency from the non-linked side.
Okay, something to watch.
Yeah, they said they're working on it. Probably a focus that sharpened in Q4 as they reviewed the full year's trends. Also worth noting, 0 NPAs, non-performing assets since inception. Speaks to good risk management.
Always good to hear.
Yeah.
And ESG, still a focus.
Very much so. They highlighted retaining top rankings and awards, mentioned green energy use, responsible investing, improving gender diversity, financial inclusion efforts. A consistent theme across the year, not just Q4 specific, but ongoing.
Okay, so wrapping things up, looking ahead, based on Q4 trends and their commentary, what's the vibe?
Optimistic.
Cautious.
I'd say cautiously optimistic, with a focus on adaptability. They're committed to sustainable growth, focusing on customer experience, innovative products.
Where do they see specific growth coming from?
They expect stable growth in retail protection, which saw that strong FY25 performance, and also non-MFI credit life. They did acknowledge the MFI, a part of credit life, faces some headwinds. They seem confident about ULPs, too, citing product enhancements like high-assured benefits, riders, nominee perks, things designed to make them appealing even if markets are volatile.
So building resilience into the products.
Exactly. And they stressed they're ready to manufacture products for different economic conditions, like if rates stay high or fluctuate, Maybe single premium annuities could pick up again. They're watching that.
And addressing those assumption changes.
Yeah, the group mortality assumption strengthening shows they're reacting to what they're seeing in claims data, proactive risk management, and finally, ongoing focus on costs, making sure the cost structure aligns with that shifting product mix we discussed. Efficiency remains key.
Okay, so if we boil it all down, focusing on that final quarter and the year.
Look, ICICI Prudential definitely finished FY25 showing growth. Q4 saw good premium momentum, and interestingly, that dip in expenses. Solvency is rock solid.
But the VNB margin pressure is real.
It is, yes, influenced by that ULFP shift and the assumption changes, which likely crystallize more towards the year end. But they seem aware and are actively managing costs and product strategy. That non-linked revival in Q4 and the strength and protection show they can pivot.
So this deep dive, pulling from all those documents, aimed to really give you that focused picture of their Q4 within the full FY25 context.
Definitely. And it leaves us with a thought, perhaps. Considering that late year pickup in non-linked sales and the ongoing strength in retail protection, how might they leverage those areas specifically in the coming year to maybe counter some of that VNB margin pressure we've been talking about?
Good question to ponder. Thank you for taking this deep dive with us.